Welcome to Echo Trade. I'm Jeff Roth. Today we have a portfolio update with Garrison Bradford and Associates, and we're going over their long-term wealth builders portfolio that's available on Echo Trade. So Garrison Bradford, I think they've been around they're coming up on their 50-year anniversary, so their opinion and their perspective carries a lot of experience and a lot of weight. So let's hear what they have to say. All right. Good morning, Bill. Good morning, Shirley. How you guys doing? Good to see you.
Good to see you.
Great to see you again.
Yeah. Happy Thanksgiving. It's Thanksgiving week. A lot of travel going on. I'm curious, though. I want to jump right in. It's been about a year and a half since you guys started the portfolio on Echo Trade. And obviously, you've been running a very similar portfolio for your clients for as we talked about, decades now. But the portfolio on Echo Trade that investors can see was started, inception was I think April of 2022 or 23, I believe. Yeah.
2022.
So, yep. So we got about a year and a half. Talk about, kind of how the buildup of the portfolio has been, how have you guys kind of navigated the markets and how have you navigated building the portfolio over the last year and a half?
Thank you for the question, Jeff. Let us first clarify what is our investment strategy, philosophy. It really is to focus on 15 or so great growth companies, because we believe when you own assets like that, it will grow above average returns, and it is a great way to protect yourself in a down market cycle. Having said that, what are the features of these companies? We have nailed it down to three elements. The first part is, of course, they must operate in a large and growing market. That is the tailwind. Number two, they must have at least one competitive advantage, because, in large and growing markets, you will attract a lot of competitors. And unless you have a competitive advantage, you cannot gain market share. And the whole idea is to gain market share and to grow at above average rates of growth for your revenue, for your earnings, for your free cash flow. And finally, what is so important is the management. You must have a great management team. What do we mean? Well, a management team who is savvy, smart, visionary, opportunistic, entrepreneurial, but most important, they must be friendly to shareholders, because we, generally speaking, are passive investors. These management team, they are the drivers. They are the ones to drive this company to multi-year above average growth. So if they keep on rewarding themselves and not take care of the shareholders, the price will remain stagnant, the stock price, I mean. So to us, that is very critical to find these great growth companies. Yes, you're right. We started the Echo portfolio in April 2022, and you all know we have had a lot of volatility in the last 18 months, starting with the Federal Reserve hiking interest rate from 0 to 5%. That is a massive, massive move in such a short time period. So we have taken it slow and only have invested 65% of our capital into this portfolio. We have recently added more, and Bill is going to share with you why we do what we do recently. Bill, the floor is yours.
Yeah. So Bill, I'll ask you. I mean, that's a good transition there, Shirley. I'm curious on how you guys go about building the portfolio, like you said. So not only, Shirley, you mentioned the three categories that check marks that you want to have, very large available market, competitive advantage, and a well-managed team. But the way you're building the portfolio over the last year and a half, talk about that, Bill, and talk about, this year, have you guys seen any opportunities to kind of deploy more of that available cash?
Yeah. Thanks, Jeff. So we felt for actually for 3 years now that the market is in the stock market is in a trading range, and the strategy within the portfolio management strategy in a trading range market is very different than if it's a trending bull market or something like that. So our goal is to build a portfolio of 15 to 20 great growth companies. We're much more focused from the bottom up on the quality of the company than we are on making top down kind of decisions related to the economy or the stock market itself. So it's all about opportunities in those individual stocks. So if the goal is 15 to 20 in the portfolio, we now have 12. 11 of those, one is a full position. 11 are partial positions where we intend to buy more when the price is right. So as Sherli says, the most important thing to us is a very strong competitive position and a wide and long runway for growth, because in the long term, it's that growth that eventually produces a home run in the stock. But we also want to be sensitive to price, and don't want to pay more than at the most what we consider to be a fair price. In the long run, the excellence of the growth is what's going to make money. But if you overpay, it's going to take a lot longer for that to develop. So recently, two companies that we've owned broadly in other portfolios, but didn't have a chance to buy here because they were pretty richly valued for various reasons. Those two stocks have come down in price. We see it as an opportunity, and we started positions there. So one of them is a company called Tyler Technologies. It's has the leading market share in software for local government agencies. Now, it's not that this market itself is growing that fast, but what it is that the IT that's employed by local governments now is way out of date, and it's going to have to be replaced. And this is going to take years, and it's going to take tens, if not hundreds of billions of dollars to do. And Tyler is the blue chip supplier in this market. At the same time, Tyler's going through a transition, the same transition that made Microsoft into a great growth company. And that's transitioning from selling discrete products residing on the desktop to putting the product and service up in the cloud, where they lock in the customer and the opportunity for significant profit margin improvement is there. So Tyler's going to grow well above average for many years, and this is really the epitome of the kind of stock we're looking for. The stock came down 40% for no reason other than it was very high priced, and we began to take advantage of that. The second one is Cheniere Energy. Another unique story. It's an energy company without any exposure to the price risk in the oil and gas commodity. They're the largest purchaser of natural gas in America, and they take that, they liquefy it, and they ship it around the world. And that is, in fact, a very fast-growing industry, because American natural gas is very inexpensive in the world market, and there's enormous demand for it. Now, Tyler sells the gas under long-term 20-year contracts to A-plus credit customers, so there's virtually no risk there at all. They grow because they build more facilities. Their record in bringing expansions online on time and well below budget is really spotless. So unless something goes seriously wrong, Cheniere too is going to be has high visibility to a very solid growth trajectory going forward. And again, the stock came down 35 or 40% and gave us an opportunity.
Well, so these were companies that you guys had your eye on, but you were just looking for a fair valuation to actually get into, open up a position.
That's exactly right. I'd mentioned one other recent trade. The very first stock we bought was Quanta Services, a neat company that has emerged as a leader in alternative energy project construction, and is the single biggest player in the construction of the hardening of and the construction of new capacity in the electrical grid. First stock we bought back in April and a year ago, and almost immediately what we're looking for worked, and that's what we call the double play, where you get good earnings growth and a big expansion in the PE ratio. So stock went up a lot. It got way overvalued. So we sold half the position. We took out our original cost and are left with a smaller position, basically at no cost. But fortunately, the stock has come down, and we're now in the process of rebuying that part of that we sold. And this is a good trade, but there's a warning here, because the biggest mistake that people who manage money like us can make is you lose your nerve and you sell your winners, your big winners, too soon. And I think it worked in this case, but in the long run, it's more important to focus on the excellence of the company and their growth trajectory than it is to spend too much time worrying about trading.
And I would like to add and bring your attention back to what Bill has said earlier, that we think that the market is in a trading range, and there are different investment strategies, in fact, to be employed. Because if it is a trading range, the stock is so overvalued, it is very prudent and sensible to take some money off the table. And that's what we did with Quanta, and it worked out pretty well.
Yeah, and so it's interesting the way you guys are approaching this right now is, again, you have waited for you're looking at the certain names that you want to get into, but you're waiting for those valuations to be fair. And the two that you mentioned have 35-40% drops where you're able to get in at a great price. And so right now, I think investors in November of 2023 are seeing that, we've had a nice, rally and a run up since July, and that valuations may be high, but you're basically saying from a bottom up standpoint, from an individual company standpoint, there could still be opportunities.
Yes. I mean, we know what we're looking for.
Yeah.
We know the names. But we also want, particularly in a sideways kind of market like this, we want to feel good about the price we're paying. And fortunately, cash is paying us 5% while we try to be patient and wait for these values to come in.
And it also leaves money on the table for when the values do come in, that you have cash to deploy. So, exactly. And obviously the approach, I mean, you're a long-term portfolio manager. It's been a year and a half since the portfolio's inception on Echo Trade, but in that short time, it's performed fantastically. I think the market is down and you guys are up. So it's done very well, and the approach has paid off thus far. And I'm sure over the long term, it will as well for investors. Bill, Sherli, thank you guys for the insight. And investors, again, you can check out the long-term wealth builders portfolio that's available on EchoTrade at echotrading.com. Thanks.
Good. Thanks very much, Jeff.
Thank you.